I'm excited to be here, as always, at BYU. I love BYU, and I love to be with the students. I am here for the next 45 minutes or so to serve you, if I can, to help you. I'm pretty open and somewhat laid back, so feel free. I'm fine with some questions. If you have something burning based on something I say, feel free to throw your hand up, and I'll try to answer it. Sound good? I hope you learned something in the 45 minutes. That's the point of being at school, right? Again, I love BYU and have been here for a long time. Does anyone live at the Village, South Campus? Come on, raise your, okay. So I own the Village, and we built the Village because there was not a place, a good place for BYU students to live. We wanted a place that was great for students. Do you guys like the Village, you that live there, I hope? We love it. Good. Big hot tub. Yeah, it's good. All the good stuff is there. Let me tell you a little bit about my story. I've been here a couple of times, and I honestly kind of get sick of hearing my story, but I hope it's instructive for you, and so I'll share it again, hopefully briefly. And then I have some thoughts around venture. I've been thinking a lot about startups and a lot about venture the last year. And so I have some thoughts that hopefully resonate with you, give you some ideas, and help you in your quest to be an entrepreneur. So like Scott said, I started here 13 years ago. I was sitting in your seat. Here is the plaque that is somewhere in the Tanner Building. Up by the office of 470, 2001. My name is still misspelled, which I like. I tell Scott not to fix it because I like the last name. It says Burningham instead of Burningham. It's good. I started a little company called MindWire. It was a technology company. I was kind of the business guy. I had a tech co-founder. There is the first key of what I'm saying today. If you are a business guy, you want to start a business, a technology business, find an awesome tech co-founder if you can. You've got to find a good tech co-founder. That was Josh for me. His name was Josh. We had a good run. We won the BYU business plan competition. We scaled the business for 3 or 4 years and eventually sold it to a NASDAQ listed company. So at the age of 25, how many of you guys are 25 or older? Raise your hands high. So maybe 20%. At the age of 25, I was sitting at a desk across from the CEO of a NASDAQ listed company. He was a Harvard MBA, like 55, 30 years older than me, and I was negotiating the sale of my business. One-on-one, just me and him. And somehow I thought I could do that. I think this is good. I think there's a couple of points that you can take from this story. Number one, at Peak Ventures, our new venture firm, we like to back audacious entrepreneurs. If there's anything that I think entrepreneurs, you know, there's been a bunch of studies about entrepreneurs and entrepreneurship, right? The only conclusive thing that I think has been shown from those studies is that successful entrepreneurs have an overabundance of confidence. Like they just think they can get things done. They think they can do things that maybe normal people couldn't do. An example of that is me sitting across from this Harvard MBA, 50-something years old, and just going, quote unquote, toe-to-toe with him. I was a BYU undergrad, communications undergrad, going toe-to-toe with him, selling my company to this NASDAQ listed firm. Obviously, I didn't win that negotiation, right? But I thought I could. And it ended up being a good exit for me. I'm not complaining, but I would have done much better now than I did then. However, I thought I could do that. So I think that's interesting. Number 2 point from that, when I was starting my startup 13 years ago, the entrepreneur ecosystem was so much smaller than it is now. And the support from BYU was so small compared to now. The point is, you don't know how good you have it and how blessed you are to be surrounded, you know, to have the Entrepreneurship Center led by Scott Peterson, to have the Founders Network, which I'm a part of, to help you grow your business. Boom Startup, there was no such thing as accelerators in 2001. No one had heard of it. So the Boom Startup as an accelerator, entrepreneurs like myself coming back and speaking. There was a little of that just starting, but it was not what it is today. And frankly, I wish it was more robust then, because do you think I would have been at the table by myself without talking to a mentor? I went in there just by myself. I didn't talk to anyone. I just made it happen. I would have been a lot better served if I had talked to Scott or someone else. You have those resources, so use them. But that was an interesting story. It was a half cash, half stock transaction. You may have, when people buy your business, it's not like it just rains money all of a sudden, oftentimes, right? A lot of times there's stock. Again, this was a NASDAQ listed firm, and we took half of kind of our proceeds through stock. And the stock honestly didn't do very well. I didn't know how to diligence or to do research really on the firm that was buying me. Again, if I would have done this again now, I would have known all about the firm that was buying me, but that just wasn't, I wasn't wise enough. I wasn't experienced enough to do that. So I sold my company somewhat blindly, and while it was a good exit for a 25-year-old kid, it wasn't as good as it could have been. But it was a good first exit. Sold to a NASDAQ listed company when I was 25. I took the proceeds from that sale and spun it into real estate. I grew up in Spokane, Washington. I love Spokane. It's a beautiful place if you've ever been there. I grew up kind of skiing and surfing on Lake Coeur d'Alene. Loved it there. It's a good place. Oh, what was my point with that? There was a reason that I was saying I grew up in Spokane, other than I just wanted to promote it. But what was it? Oh yeah, real estate. My dad grew up kind of doing real estate. I spent a lot of my Saturdays growing up at like duplexes or fourplexes my dad owned, like cleaning the carpets or painting the walls or whatever the case may be. And so I liked cash flowing real estate, and I knew a little bit about that. So after I sold my technology company, there was a 2-year earnout on my stock. So I opened an office at the Cottonwood Corporate Center up in Salt Lake City, and kind of on the side I was doing real estate. So I took the proceeds and invested in real estate. And what was happening in real estate when you guys were like in, I don't know, 5th grade or 6th grade or something like that? It was a good market, right? If you've read your history books, like the mid-2000s for real estate was unbelievable, right? So I just killed it in real estate, and I did nothing special. I was kind of riding the wave up with everyone else. But what I did recognize, so I started buying things all over Utah. And what I did recognize, though, after a couple years of doing that, was that this growth, and so here's maybe another lesson in this story. This growth was unsustainable. There was no way that the appreciation we were seeing in the real estate market could continue like this. So it scared me to death, right? And so in 06, I sold almost all the assets I owned. I actually sold all of them except one. And I still own some land on a Jack Nicklaus golf course in Austin, Texas. Scott, if you'd like to buy, great buy. I wish that I did not own. I'm underwater on that investment. But 7 of the 8 assets I owned, I sold. I brought the money home. As Scott said, and I'll say this little part of the story because we are at BYU, after I sold my technology company, I was headed back to graduate school in Boston. And when I say Boston, most people think Harvard, which is right. And most people, because of my background, think MBA, which is wrong. I was actually going back to Boston to get a master's in theological studies. And my stake president, I was an executive secretary in a stake presidency. My stake president knew I was leaving, and he called me to be a bishop when I was 27. I'm 37 now. So 10 years ago, he called me to be a bishop in the Provo, Utah stake, the original stake in Provo. And so I stayed, is the point. Again, I usually don't tell that, but I'm at BYU. So that is why I stayed, is because I was called to be a young bishop. And I sold the assets I owned, and I had to look around and say, what are we going to do now? I'm here as a bishop. I'm committed to fulfilling this calling. And so I gathered 2 of my best friends and 2 of the super smartest guys that I know. my two partners at Peak Capital, their names are Jeff Danley and Jamie Dunn. Jamie and I ran the Management Consulting Club together at BYU as undergrads. Does anyone participate in the Management Consulting Club at all? So my senior year at BYU, I was finishing school, running my startup, and flying around the country with Jamie, interviewing at Bain and McKinsey and other companies. And ultimately, obviously, decided not to do that to stay with my startup, which was the good decision for me. Jamie went to Bain. He got an MBA at Wharton. He met Jeff Danley, our third partner, was an MBA at Dartmouth, and they met at some LDS networking event in Manhattan. And so when I decided, you know, when I was stuck in Provo as a bishop, I thought there was going to be a pullback in real estate. Again, I was kind of a contrarian. Real estate was continuing to climb. I probably could have even invested my money one more time and maybe turned most of it one more time. But I was nervous. I was bearish when everyone was bullish. So I sold the assets I owned, and we formed Peak Capital Partners in '06. And, oh no, I want to tell you this. I'll come back. So we started Peak Capital Partners. And the plan was to buy real estate, cash flowing apartments. Why do you think we like apartments? Curious. Think about it. Throw me out some answers. Just yell them out. Why would we like apartments in kind of a down market? Yep.
They're always full because people are losing houses and need cheaper rent.
Good. Yep. So people, one of the last things people will give up is a roof over their head, right? And so in a bad situation, you know, you need homes for families. And we take pride, by the way, in owning kind of nice, clean, affordable affordable apartments for families. We now house 13,000 to 14,000 families. And we take pride in that. So that is a good reason. Why else? There are other reasons.
Well, you lived in Provo, and Provo is very much a college town.
Yep, it's good.
Nationally, people are getting married later.
Yep, there's a trend, right? There's macroeconomic trends that are pushing people into apartments. It's much harder to get a loan now on your first house. What about inflation? Let's talk about inflation for a second. In an inflationary period, real assets like the village, like apartments, act as a hedge against inflation, right? Number one. Number two, rents can be adjusted based on inflation, right? Different than retail or office, on most of the units we own, there's a year-long contract, right? And most of those are turning over in different months. And so every month we can adjust pricing based on inflation, right? So if we hit a hyperinflationary period, we can adjust rents. So anyways, it's a good hedge against inflation. So for all of those reasons, we went big into apartments. We'll hit $1 billion in asset value, I think, by the end of the year. That's kind of our goal. I think we'll do it. We own about 90 assets. We were the 6th fastest growing company in Utah, named to the Inc. 500 in 2014, like Scott said. Go ahead.
Back on the East Coast, rent control apartments are a big thing. Is that a concern for you that it will spread?
It is. So the question was about rent-controlled apartments. It is a concern. We own nothing on the East Coast or in California, because there's rent control. So we look at kind of conservative, undercapitalized states, secondary or tertiary markets, if that makes sense. So not San Francisco, not LA, not New York, not Boston, but Oklahoma City, Salt Lake City, Albuquerque, New Mexico, Phoenix, Arizona, Dallas, Texas. We own a lot in all those markets. One of the reasons is because we don't, rent control is an interesting subject that I could talk a long time about, but that's kind of boring, so we won't talk about that. Good question. So we did this. We built the village. We did some opportunistic deals as well. We bought the land that the village now sits on out of bankruptcy. It used to be a school, an elementary school, and we bought it out of bankruptcy and decided to build the village. And we decided to do it nice. When we were building the village, we had a strategic decision to make. We could have built another Liberty Square or whatever, which is a great place, or whatever place, or we could go a little bit higher end and try to cater to a demographic that maybe a market that wasn't being served at BYU yet. So we probably put, I don't know, 5 to 10 million extra dollars into the village than what we had to, because we thought we wanted to make it a nice place for students, and we plan on owning this asset for 50 years, at least as of now. So my kids will live here. My oldest child is 13. He'll probably live here someday, and et cetera, et cetera. So these are my partners, by the way. You see me, and then my partner is Jeff Danley, and then the the poorly dressed guy in the tan suit with the ugly socks is Jamie Dunn, if you can see him from there. He's a terrible dresser, but a good guy otherwise. I'm only saying that because he loves to dress very nice, and I love him. He's one of my best friends. So for me, real estate, kind of going on with the story, real estate was kind of opportunistic for me. It was an opportunistic investment. In 2006, again, I kind of looked out and saw there's going to be a pullback in real estate. I had no idea how big it would be or how bad it would be. I just thought there was going to be a pullback. So I wanted to invest my money and other people's money into real estate when the market hit. I felt like for the next decade, again, this is in 2006, so we're 8 years through the cycle, that for the next decade, the best risk-adjusted returns on capital would be found in real estate. But what I love is startups. Venture capital is what I love. So all along this time, while we've been growing Peak, I've been focused on growing this real estate portfolio, but I've been looking at venture deals the entire time. So much so that my partner, Jeff, Jamie, and I, we've been peeling off profits from the real estate and investing back in early stage startup companies, just the three of us, for the last 4 or 5 years. And we've probably invested, I don't know, $3 to $5 million of our personal money into startups the last 3 or 4 years. But now we've raised a venture fund. It's called Peak Ventures. It's a $23 million fund. These are some of the companies that we've invested in. If you've heard of them or know people at them, or you can look them up if you're interested. There's some really cool companies. If you have questions about them, I can answer them in the Q&A. This is an interesting quote. This is Paul Allen. Has anyone heard of Ancestry.com? Hopefully. So we own a little office building in the Riverwoods. It's the 3-story building right across from Vivint, the brand new Vivint building in Riverwoods. We're on the top floor, the 3rd floor. So as I sit in my office, I look at $3 billion technology companies in Provo, Utah. There was just an article that featured myself, Ryan Smith at Qualtrics, and Todd Peterson from Vivint. It was called Provo Rising. It was in this national publication. Shane, do you remember the magazine? I don't remember what it's called. Some magazine about Provo and like what's going on in Provo. This is an exciting time to be in Provo if you're a technology entrepreneur, by the way. I don't know if you know that or realize that, but like this is the time. This is a good time to be in Provo. Again, from where I sit, I look at Ancestry.com, Vivint, and Qualtrics are literally right across the street from me. $3 billion technology companies. Again, when I first started my startup 13 years ago, there was nothing like that. Omniture wasn't even called Omniture 13 years ago. It was called superstats.com or mycomputer.com maybe at that time. So there has been tremendous growth. And we want to serve the entrepreneur. Our customers are entrepreneurs. Paul Allen was the founder of Ancestry, and he writes a blog, and I just want to read, because I think he encapsulated well some of our thoughts. This $23 million fund in Provo may not seem like a big deal to some of you. Silicon Valley has many billion-dollar venture funds, after all. But for startups in Utah, this is huge news. Even if a single startup funded by Peak Ventures follows the path of billion-dollar Utah companies such as Omniture, Vivint, Ancestry, Inside Sales, or Qualtrics, the ripple effects will boost the economy and entrepreneurship for years to come. So I started a venture fund because I want to give back to early stage startup companies. I want to mentor young entrepreneurs like yourself. I am choosing to do that with my time because I love it and because I think this is a great time to do it in Provo. Our thesis is that there are an overabundance of good ideas and good entrepreneurs in Provo and in Utah, and kind of an undersupply of sophisticated good capital. There are some good capital groups in Utah, but there's not enough of them, and we're going to do things a little bit differently. Again, in our view, entrepreneurs are our customers. We exist to serve them, to help them grow. When we invest in your startup, we have your back. We sweat with you. Not only do we give you cash, but we work with you. I have a great partner who is a BYU grad. He had an exit to a Bay Area company. He started a company called Zinch here locally, an ed tech company. Sold it to Chegg in the Bay Area. He's kind of my partner. And then we have he's part of the founders group. Sid Kromenhoek is his name. And then we have 3 other guys that are great, great guys to work with. So let's talk about venture for a minute, and let me give some thoughts, and let me answer some questions. First of all, here's a little bit about the fund. We'll do 25 to 30 deals. We'll invest 300 to 500 grand per deal. Our investment focus will be technology and the U.S. Mountain West. So 60% of the money will be invested in startups, and then we'll reserve about 40% of the fund for follow-on investments. Do you know what that means? When we see a company running, when we see a CEO we really like gaining traction, we will double down, triple down on that CEO and invest more, right? So that's what the follow-on component is. 20% of the fund as well, is saved for secondary transactions. Secondary transactions are like opportunistic opportunities to, like, let's say, buy into, one of these companies we've been talking about, or an entrepreneur liquidity fund or event. So let's say I'm an entrepreneur who wants some liquidity. I want to keep running my business, but I've been bootstrapping it and working hard for 5 years. I'm ready to take a little bit off the table, but I want to keep growing it. We will be there to help you take a little bit off the table, and we'll invest in your business at a little bit later stage. We're looking at a couple really interesting secondary deals like that. So we announced 4 months ago. Well, how many deals do you think we've seen in 4 months? You may have just saw that, but the top of the funnel. 805 deals in 4 months. So there are a lot of deals, and there is a lot of demand. One of the hard things about being a venture capitalist or about owning a fund is, as you can see, you say no, let's see, 98.6% of the time. And that doesn't mean we don't like you. That doesn't mean we don't believe in you, that you're not a good entrepreneur, that you can't make it happen. It's just simple numbers, and it just doesn't fit like our criteria, right? So we've seen 805 deals. We've only been able to screen 80% of those. We're trying, again, I have a team of 4 guys that are working all day to get in front of these companies. We've done diligence on about 12%. We've negotiated with about 2.5%. And we've funded 11 deals so far in the fund. I don't know if this is interesting to you, but this is data, again, from our fund that I'm sharing with you. We believe in transparency. We believe in being super transparent and sharing information. Here's the deals by state. So 40% of the deals we've seen have been in Utah, 25% from California. You can see the rest. Here are the deals by industry, right? 5% fintech, 7% real estate tech, and you can so on and so forth. We are opportunistic in our investments. We've led, have any of you guys heard of Studio Design? It's an app. It lets you design, put design on your photographs super simply and in a super easy way. It's an app. You should check it out in the App Store. It's free, Studio Design. But so we backed an app company. We've backed Toot Genomics, which is a genomics SaaS company. We backed Screeny, which is an HR SaaS company. So we're opportunistic in the investments, and we're open to all types of investments. However, obviously we have some favorites based on our backgrounds. So what do you think my favorite is? What? Real estate tech, right? I own $1 billion of real estate. That's a really interesting laboratory to like throw ideas up into, to like pivot, kill bad ideas, or pivot and scale your business. So I love real estate tech, and we've looked at a lot of real estate tech. My partner Sid has a background in ed tech, so we like ed tech. We also like massive markets that are going to be disrupted, like education, like real estate, like finance. I'll talk a little bit more about that as we go along. I'll talk about it right now. So, some startup thoughts for you. Any questions on this stuff? Real quick? Go ahead.
What's the name of that app again?
Studio. Yep. So here's some thoughts I've been having. I'd like to talk about these for a minute or share some ideas with you. Guys, hopefully they provide some thought, you know, maybe give you some ideas. If I were in your shoes right now, here are some things I would be thinking about and looking at. These are some thoughts I would have. Number one, big data. You've probably heard of that, like it's a buzzword, like big data. But big data plus fast data equals or means massive disruption to any slow-moving bureaucratic organization. So that means education, government, healthcare, financial services. These are all areas that I think will be massively disrupted by kind of this wave of technology, this big data plus fast data. They're not really built to move quickly. They're not really built to analyze data and to make moves quickly based on data. I think there's a lot of opportunity with the kind of this idea. Let's see. Okay, so these are the studio guys actually. This is in San Francisco. This is my partner Sid. My assistant, by the way, just like picked pictures. She's like, you got to have some pictures. So she picked pictures for these. So this is a recent trip to the Bay Area with the studio guys in the back, who again we backed or invested in. This is my partner Sid in Peak Ventures. This is me. When you bootstrap a business, you are essentially trading time for money. What does that mean? Thoughts, entrepreneurs. What do I mean when I say that? That doesn't mean it's bad to bootstrap, by the way. I love bootstrapping. And there's a lot of data that basically says one of the worst things you can do for a good startup is give that startup too much money too early. It's almost like kind of, you'll get the analogy. It's kind of like spoiling children, you know. I have children, and if I give them everything when they want, it just kind of ruins it. Same with startups. So I like bootstrapping. What does bootstrapping mean, and what am I saying here? Thoughts? Did you have a thought? Go ahead.
Bootstrap, you're essentially trading time for money because instead of scaling your business to grow as fast as possible, you don't have any capital to do that.
Yep.
Instead you go to somebody like you, get money, scale it.
Yep, so when you get money from a venture capitalist or from an angel investor or whatever, you're able to hopefully deploy that capital and shorten your time frame to scale, right? When you bootstrap it, bootstrapping means you don't take money, maybe a little bit of family and friends money, and then you grow it yourself. You're gonna take a longer time. It might be the right play, but it's gonna take longer. It should take longer. This is almost always the case. Any other thoughts? I think I saw another hand up here, or, yeah. Yeah, I heard like 70% of that. So I think, when you bootstrap, obviously, you don't take money, so you don't give money, or you don't give equity away in your company, right? Yeah, that's totally true. That's totally true. And there are kind of two different types of businesses, right? I'm sure you've learned about this. Kind of the lifestyle business versus a scalable business. I love lifestyle businesses, man. Cash cows that you can just enjoy your life, have a great lifestyle. And then there's kind of the scalable type businesses. One thing I would say to that, just FYI, at some point you're going to give some of your company away. Now the longer you bootstrap, the higher valuation it should be, right, when you raise money. But if you really want to scale, you're probably going to have to take, I don't know what the percentage is, but I would guess 90% of startups that really scale, technology startups, at some point take money. So they dilute, right? They give equity away for that cash. But the longer you can bootstrap, hopefully the more value you've created in your business, so the higher valuation you'll be able to command when you raise money. Does that make sense, guys? Here's another thought, though, that kind of goes along with this. And this is my family, by the way. This is my wife, Sally. And then Dallin's my oldest son. He's 13, so I have a teenager. Get ready for that, guys. It's fun. Truman is 10. Claire is 7. And then James, our youngest, is 3. This is actually a good picture to choose because here's my point. Starting a company will consume your life for some period of time. Sometimes shorter, but usually longer. The reason this is a good picture is because I took my family to New Zealand and Australia for a couple of weeks this summer. But that was like the first, real extended vacation together that we've taken in a long time, because starting a business is hard and it will consume your life for some period of time. There will be seasons in your life where you will be unbalanced, whether it's towards church when you're a bishop or maybe a Relief Society president or whatever, or whether it's to your family when there's a strong time of need in your child's life or your wife's life, maybe health concerns, or in business. When you start a business, I don't know if you can be balanced. It will consume your life for some period of time. So be prepared for that. Be emotionally ready for that. Make sure the loved ones that are supporting you are ready for that fact, because I think it is a fact. You will be consumed by your business. And there are trade-offs. Growing a business is fun. It's great. But you do miss out sometimes on family things, and it's hard. But the reason that I share this slide after this one is because in a lifestyle business, I think it's actually easier to manage this stuff. You don't take outside investor capital. You can take it at your own pace. You can provide a good living for your family while being in total control of your life or lifestyle. Make sense? Thoughts? Yeah, question.
Explain your quick lifestyle business or scale business. Give a couple examples.
Yeah, like a lifestyle business would be like a landscaping business, a barber shop, usually a restaurant, usually. Those are kind of lifestyle businesses. Like they provide a good living for you. You work in them. But when you're not working, you're not making money. Right? A window washing business. That's hard to scale at a big level, right? A scalable technology business are like the businesses we've spoken about. Right? Does that make sense? Good question. Other questions about or thoughts about these slides? Okay. Here's a thought. Have you guys heard skills pay the bills? You guys know that. It's an old school funny saying that I used to say with my friends, like as a joke, right? But it's true. Also, I was a college basketball player. True story. I was a point guard. I love basketball. I love to compete. It kind of reminds me of that too. But this funny statement has never been more true than now. Real skills are the currency of this new economy. So what does that mean for you guys? What are the consequences for you guys because of this? I think this is true. This is becoming more true every day. Your degree might not be enough if you can't do something. You've got to be able to, it's great to have a degree. You've got to be able to do something with it. You've got to have skills, right? That more and more that is becoming the currency rather than maybe even a diploma or whatever. It's skills that you've created. And school can help you create those skills. Another great thing that can help you create those skills, I'll tell you, is starting a startup. Thoughts or questions about this? Comments? Concerns? Here's another thing, another thought that goes along with this. So this is a picture of the village, I think, with the Y in the background. In today's world, the imperative to learn cannot be overstated. So the question for you guys is learning in your DNA. Is it part of who you are? You need to continually learn. I'm not a developer. I'm not a programmer. But if you are a developer or programmer, I think you know, a vast majority of what you know now will be obsolete in like 18 to 24 months. You've got to constantly be learning. You've got to always be learning. And so the question is learning part of your DNA? Whether you're not just here at BYU, but after BYU, will you continue to learn, again, these skills that kind of really matter? That's what counts, and that's what's important. So these are some thoughts I've been having recently about startups. Let me go back to the beginning where I skipped over something important. And these are my last kind of concluding thoughts. I have 2 thoughts for you to leave. We have about 9 minutes, and maybe there'll be a little time for Q&A here. Honestly, I'm going to get a little more personal here. I was kind of, when I was in your shoes, I was a reluctant entrepreneur, honestly. Kind of a reluctant businessman. And it's because when I thought of business or when I thought of entrepreneurship, I thought about money or awards or some of the things we spoke about here. We have spoken about money and awards here, but I just want to tell you guys, and I mean it, that is not what matters. I hope if you're an entrepreneur, you're not doing it for those things. You should be doing it, in my opinion, to better yourself, to be the best you can be, and to bless other people's lives. That is why we are entrepreneurs. We have about 100 people or a little bit more at Peak Capital right now. It's great to provide jobs for 100 families. We house 13,000 to 14,000 families in our apartment units. That's satisfying to know that that's a lot of families. There's a lot of stuff, if you can imagine, going on in our apartments, the things that we own like every day. Hopefully a lot of good things. You should be doing business for the right reason. I didn't understand business very well when I was, again, in your shoes or in your class. But what I've come to know is what Clayton Christensen said, that if done well, management is among the most noble of professions. This should drive what you're doing in business and or in entrepreneurship. This should be the driving motivation, not money, not awards, not fame or whatever. That can all maybe come eventually if you do it right. But I'll tell you that those things are more fleeting than things that matter most, like this. You got it? This is the reason to do business. Now let me go to my last thought. It's tied into this. And it was at the end. And this is something I've thought a lot about too, because I'm kind of a type A personality, kind of a driver. I think to be a good entrepreneur, you've got to push boundaries often. You've got to be audacious, like I've said. And so I've often thought about this balance, and whether it's in church or business or, you know, your basketball team, whatever, what is more important, the relationship or the result, right? So again, kind of going back to my analogy around, or my thoughts around management being the most noble profession. If you will always prioritize relationships and focus more on relationships than the result you're trying to get, you'll be a happy person. And you'll be a blessed person, and I think you'll be successful. By whatever measure that is to you. You should always overweight relationships versus a result. And there have been times in my life, and I'm sure there have been times in your life. I remember the first year of my mission. I served my mission in Charlotte, North Carolina. This is just one example. I was a crazy person. I was a crazy missionary in a good way and a bad way. In a good way because we got a lot of results, right? I think the average missionary, did anyone serve in Charlotte, North Carolina, which is my mission? I think the average missionary in Charlotte baptizes like 1.7 people, their entire mission. And I think, I did a lot more of that, more than that just in my first year. So the results were good, but I was pushing them in the wrong way. I was too harsh with my companions. Like I just pushed them like crazy. I wouldn't let us stop for lunch. We never stopped. I didn't have lunch the first entire year of my mission. Never had lunch. Literally, I don't think I ever had lunch because I would not let my companions stop for lunch. We'd never go back to our apartment for lunch. The point is, and the reason that's kind of a dumb example, but I think you'll understand it, I was more focused on a result than relationships. And I think I burnt out some of my companions, and I wasn't as Christ-like or kind in those relationships as I should be. Same thing with my first startup. I was really driven to have success and maybe wasn't as good to my first partners as I should have been. The point is, always overweight relationships, guys. Like, always overweight the relationship. You need to take the long view. What you don't understand right now, sitting where you're sitting, is that Scott, although he's 50 or so, is a very young guy. You don't understand that. I'm 37. I'm a very young guy. Scott still has a lot of good things to do. I still have a lot of good things to do. But when you're sitting here in your 20s, you think 37, that's forever. 50, that's old. It's not really that old. So the point is, take the long view in things. Even though you're young and it's easy to take shortcuts maybe, or to push for some result in the short term, don't do it. Always overweight relationships. Always treat people that you do business or life with in the right way. This is a simple kind of model to think about that I think I wish someone would have told me this or talked to me more about this when I was your age. So remember that, guys, and have fun and do good. And that's the end of my remarks.